You're watching Silver News Daily. Subscribe for more.
Or real darn close to it anyway. So two broke nations buying each other's debt as the rest of the world seems to be favoring things like commodities and cryptocurrencies or whatever the heck they can get their hands on that are tangible, copper or silver, gold or platinum, which we saw a microcosm of a short squeeze yesterday and a little bit today. And I think that's on a larger scale what you could expect to see in the silver market. But yeah, it's an interesting time right now, and certainly I think it focuses squarely on the bond market. That's where really the trouble lies, and the question being, you raise the debt ceiling, you go around the world imposing tariffs that in many respects are actually sanctions masquerading as tariffs. You continue to spend irresponsibly, and the world at some point says, we just don't want to purchase your debt anymore. And maybe that's kind of part and parcel what Zoltan Pozsar was talking about, this move to Bretton Woods 3, a system that will move away from promises from an opaque debt system. And if you think about the concept of buying someone else's debt, another country's debt, and calling it an asset, it doesn't have a huge history compared to things like, tangible assets. And he said, that's where we're going, a system that will be transparent, like blockchain, and one that will be backed by commodities. And, the old saying, he who has the gold makes the rules. Well, that's exactly what President Trump said on Easter Sunday in a tweet, which is interesting. With the amount of gold coming into the ComX, the largest deliveries in the history of the ComX in the May contract, over 16,000 contracts, that's $5.3 billion worth of gold delivered in the May. That's over a 700% increase year over year from this time last year. But this is every single month we're seeing it, and it's not stopping. And I think you're seeing a lot of players that are choosing physical gold in your possession, which is outperforming the bond market as an alternative to it. And it's not just here in the United States; it's everywhere, and even in places like Japan. So yeah, this is just beginning. We'll see how it all plays out. We've all lived under this belief that these types of issues will always be resolved and papered over, and they always have been, I guess, maybe until they're not. But right now, these are certainly interesting times.
The entire financial system is spiraling, and the alarm bells are screaming louder than ever. Behind closed doors, the Fed is panic buying treasuries, pumping billions into a collapsing bond market just to keep the whole thing from falling apart. But here's the catch. It's already too late. The cracks have turned into canyons, and investors around the world are waking up to one brutal truth. Fiat is failing. Gold's blasting past all-time highs. But silver is going vertical. We're not talking about a slow grind higher. We're talking about a full-scale detonation, the kind of parabolic move that leaves even seasoned traders stunned. Look around. The ComX just saw record silver deliveries. China's hoarding physical metal. Russia's buying it by the ton. And while mainstream media stays asleep, those paying attention are quietly preparing for silver at $100, $300, maybe even $500 an ounce. That's not a pipe dream, it's a math problem. And when the numbers stop adding up, panic sets in. The banks are on fire, the dollar's on thin ice, and silver is emerging as the last true refuge. So what's really driving this silver supernova? What are the elites hiding from you? And why is physical metal disappearing faster than ever before? Stay with me, because once you understand what's happening behind the curtain, you'll see why $500 silver might not just be possible, it might be inevitable.
Yeah, it was the worst 20-year auction perhaps in history, from the way that I look at it. In fact, I think it is the only the second. Let me put it this way: it may be the first or the second highest yield for a 20-year bond auction in history. There may have been one other. I read about it an hour or two ago, and it talked about it being over 5%. And I could have sworn it said it was the worst in history, if not the second. And, you're witnessing, whether it be here or in Japan or in the UK or all around the world, the bond markets are in very big trouble. I think the concept of owning debt from an insolvent country, one that is irresponsible with their fiscal policy, even in the face of Doge asking to raise the debt ceiling once again. this is emblematic of what we just saw just the other day, where the Fed had to come in and quietly, in what they call stealth mode, I guess, where they're not calling it QE, bought 43.6 billion worth of treasuries in 1 week, 20 billion in 3 year, 34.8 billion in 10 year, and 8.8 billion in 30 year. The Fed is coming in because no one wants to buy our treasuries at these levels, and you can see it here on the 20-year. That's probably why the market turned around and threw up the way that it did. And you can look at the Japanese market, same thing. I think there is a certain segment of the Japanese population, forget about the unwinding of the Japanese carry trade. I mean, that's very detrimental in and of itself. We saw what happened a month or so ago when rates in Japan first started to move, and everything calmed down, but here they are moving up again. And I think one of the reasons you're seeing gold catch a bid is partially because I think there are a lot of traders in Japan who figure the BOJ is going to have to turn around and go back to yield curve control, which should be very, very bullish for gold. But what you see happening here is an interesting phenomena. The Fed is trapped between inflation and keeping rates down. I don't know how they'll do both, but you can see the market perhaps is even stronger than the Federal Reserve. And what's really interesting about all of this is that gold is moving up in the face of rising interest rates. Now, we're always told that rates go higher, gold goes lower, the inverse correlation between the two. But when you factor in what or who's issuing the debt, I was listening to a Bill Fleckenstein interview, and he said, on Wall Street, we used to call that a who-to problem. Who do we sell it to? And I think that's the issue, is that, we're finding a pool of a diminishing pool of interested parties to buy our treasuries. And it's funny, you see China, who is now slid to number 3 in treasury holdings, replaced by the United Kingdom. Vince Lancy had a great analogy. He said it's like two drunk guys holding each other up from falling. You have, the largest debtor nation buying debt or selling its debt to the second largest debtor nation. And
the debt markets aren't just shaky; they're in free fall. The very backbone of the global financial system, U.S. Treasuries, is buckling under the weight of relentless deficits, ballooning interest payments, and evaporating demand. For decades, these bonds were seen as the safest asset on Earth. But now, traders are dumping them, yields are surging, and liquidity is vanishing like a ghost in a storm. The warning signs were subtle at first. Wider bid-ask spreads, dismal auction participation, and foreign buyers slowly stepping back. But in 2025, it's become a full-blown rout. What changed? Everything. The U.S. government's borrowing needs have exploded, with trillions in new debt flooding the market. But buyers? They're drying up. Japan is reducing exposure. China's moving to hard assets. Even domestic institutions are getting nervous. And the result is pure chaos. Interest rates are spiking, bond prices are plunging, and the Federal Reserve has been forced to step in, not because it wants to, but because it has no choice. And this intervention isn't a footnote. It's the story. Because when the market loses faith in the one asset that's supposed to be risk-free, the entire system is at risk of snapping. That's why the Fed's sudden and aggressive Treasury purchases are setting off alarm bells. It's not just about maintaining liquidity anymore. It's about survival. And in the background, something even bigger is brewing. The rapid repricing of real assets, with silver poised to explode as the ultimate flight to safety play. This isn't a drill. The very structure of debt markets is cracking, and the aftershocks are only just beginning.
Speaks to the inverse relationship between real rates and the price of gold. And as rates continue to rise, even if we have to suspend the fact that we know that the CPI is a bunch of crap, but let's just take it at face value. That's what the market uses. Well, as the rates right now are certainly over the CPI, that is a return, a real return. One would expect that gold, which does not pay a real return, should be retreating. And one of the hallmarks of this market that is vastly different, Dunnigan, than anything I've seen in 35 years is, it's kind of like a fight in high school where, you hit the kid, he never gets back up. You're watching two kids fight. One hits him, he never gets back up. But this time the kid keeps getting back up. He gets hit and he gets back up. He gets hit and he gets back up. And I've never seen that before. Maybe that's a bad analogy. But the point of it is that It never did this. It would get hit and it would be down for years and sometimes even longer than that. And you look at 2011 when it hit $1,900 and it was down for a long, long time, 8 years or so, 7, 8 years before it finally came back. And but this time seems to be different. It goes down 100 or $200 and comes right back up. And the demand in Asia is overwhelming. And you can see it. It's almost as if the Chinese now are controlling the price of gold. I don't think they are with silver yet, but there was a very interesting tweet by Eric Young. I don't know if you've had him on your show. You should if you haven't. He's the King Kong on Twitter. He's phenomenal. He lives in Hong Kong, I believe. I've had him on mine. He has a very, very interesting take on things. And today he basically said China's involved in all of this too, suppressing the silver price because they're trying to accumulate every ounce on the planet. Think of them going around buying the doré and the concentrate, as we've talked about. And what he's basically saying is that they're thinking for years to secure supply for their country for future generations. He said, just hold on, you'll see silver be triple digit, don't let go. So interesting times for sure.
The Fed is in full-blown panic mode, but they won't admit it. They're not calling it quantitative easing. They're not labeling it a bailout. But the reality is clear. They're flooding the system with liquidity through silent treasury purchases, desperately trying to prop up a market on the verge of implosion. On the surface, they claim these are routine operations, just managing market functioning. But if that were true, why are the numbers so staggering? Why now? And why so suddenly? The truth is, this is an unofficial QE, liquidity injections dressed up in technical jargon to avoid sparking more fear. The Fed is stealth buying bonds to stop yields from spiraling and prevent a catastrophic domino effect across banks, pensions, and money markets. These institutions are sitting on mountains of treasuries, and every basis point rise in yields slashes the value of those holdings. If the Fed doesn't intervene, we're talking mass insolvency. But this lifeline comes with a hidden cost: credibility. Every dollar the Fed prints to buy debt chips away at the value of the dollar itself. Every emergency action signals to the market that things are worse than they appear. And as that trust erodes, investors aren't just questioning the Fed, they're ditching fiat altogether and stampeding into hard assets. This is why silver isn't just going up, it's erupting. Because once the Fed loses control of the narrative, and markets realize this isn't stimulus, but triage, the flight to real money begins. The Fed can suppress rates, it can prop up bonds, but it cannot print silver. And that's where this is all heading.
Funny, they talk about, and I don't know why they decided to do it now, right when you have an administration actually addressing the irresponsibility and the corruption in basically the evisceration of our currency through ridiculously irresponsible programs that the government has spent our money on. Now they want to do it, not before this. I don't, I think Moody's is kind of nonsense, to be honest with you, but they talk about a warning of a debt to GDP hitting 134 by 2035. But the truth of it is, if we add in the unfunded liabilities, we're well north of 200. And, they say an interest burden will consume 30% of the revenue by 2035, up from 9% in 2021. Well, the Congressional Budget Office also said by 2031, every penny of tax revenue will go just to pay the interest on the debt, and these mandatory off-balance sheet entitlements, Social Security and Medicare as an example. So anything that's discretionary, like military, which is $1 trillion bill this year, will be borrowed. And at what point do we realize that the world has lost appetite for the Treasury? So who's going to buy it? It's that who to problem again. Who are you going to sell it to? And when you see the Fed come in and not even admit the fact that it is quantitative easing, that they are buying treasuries, and they do that, they're trying to plug a hole in the dike to keep the bond market together and to keep this from accelerating. But, this is a real problem. At some point, the irresponsibility catches up with you. At some point, the way that we behave on the international stage, the tariffs, the threats, the sanctions, the spending, the borrowing, the raising of the debt ceiling, on and on and on. At some point, I think the attractiveness of our debt looks silly. And anyone who would hold duration of any length greater than 6 months or less, I think is a fool in this market right now. And the bond market is proving that to be true. And again, it's really interesting that as rates are going up, so too is gold. Gibson's paradox.
Confidence in the US dollar is beginning to erode, and it's not just coming from the fringe. It's coming from central banks, sovereign funds, and institutional giants who are quietly moving their chips off the table. For years, the dollar was king, backed by the world's deepest capital markets and the full faith of the US government. But when that government is printing trillions, buying its own debt, and monetizing deficits with no end in sight, the illusion starts to crack. The DXY may still read strong at 99.53, but beneath that surface strength is a rotting foundation. The Fed's aggressive balance sheet expansion, coupled with fiscal recklessness from Washington, is sending a loud message to the world. The dollar is no longer a reliable store of value. Foreign creditors are watching carefully. China and Russia are building reserves, not in greenbacks, but in gold and now silver. And retail investors, they're waking up too. There's a slow-motion exit happening. Not a crash, but a controlled demolition. As confidence drains, fiat currencies become what they always were, promises. And in an environment where trust is everything, promises don't hold up. That's why silver isn't just benefiting from inflation fears or industrial demand. It's becoming a currency hedge, a vote of no confidence in the entire monetary regime. Because once the world stops believing in the dollar, the rush into real money accelerates. And silver, still trading near $33, looks like the biggest mispricing in the entire financial system. That's the opportunity. That's the warning, and this is just the beginning.
We sure will, and we do hedge so that we can handle whatever the price is, those kinds of transactions. So yeah, I think that the price or the ratio is irrelevant. One thing I wanted to mention, I was looking at, Vince Lancy has a very good take on the markets, and I was looking at a string of texts between him and Luke Gromen and talking about Vince is basically saying that we were that close to a major international regulatory crisis and it was averted. And he says, now it makes sense. I want to read something to you and give all the credit to Vince and to Luke, but I think people should hear this because it's really kind of crazy if it's true. He says, the ComX delivery that was shut down, the extended shell games of metal going on for months, the seeming liquidation only behavior, meaning they basically got together and said, no buying, fellas, no buying, only selling. And I don't know if that's true or not, but he says the seeming liquidation only behavior, bullion banks covered shorts and funds sold. Normally, funds would not let the banks off the hook. This market became liquidation only. It was so bad. Have been involved on both sides of the table with those. It's a lockdown, circle the wagons type panic. We came close to a serious problem. It was near a meltdown in the gold market. Physical gold wasn't available to meet delivery promises, so major players scrambled behind the scenes. Bullion banks were in trouble. Big funds bailed by selling, letting the banks off the hook. The market got so shaky, they made it liquidation only. You could sell but not buy. It was full panic mode, but they managed to patch it up before it blew up publicly. It shows the system isn't as solid as it looks. If people can't count on getting real gold when they want it, trust in the market could break down. Going forward, more investors might avoid paper market and demand the real thing, blah, blah, blah. Now, Luke Gromen says, now imagine what happens if it was the U.S. government bringing the gold back, and the response to all of the above, talking about the banks, from the U.S. government is F you. Send us more gold this month and next month too, and more behind for July, August, and September. Vince then says, it was, Luke, it was. No ifs, ands, or buts. You know it. Bullion banks to cover the Treasury, calling it back, or the Department of Treasury itself, it most certainly was. So here you have two of the smartest guys on the planet, more or less saying that
gold has already fired the first shot. While the dollar teeters and the bond market convulses, gold is breaking out, signaling that the smart money is running for cover. Central banks have been loading up for months, breaking purchase records quarter after quarter, and they're not buying ETFs. They're stacking physical bars, shipping them in bulk, and repatriating gold from foreign vaults at a historic pace. This isn't about speculation. This is about survival. Every time gold breaks a new high, it sends a message. Faith in fiat is dying. But gold isn't alone anymore. Silver, its long-neglected sibling, is starting to stir. And when silver wakes up, it moves fast. Historically, gold always leads the charge. But once silver joins the fight, it doesn't just follow. it erupts. In 1980, in 2011, and now again in 2025, gold's rally has been the match, but silver has always been the explosion. Right now, gold is screaming inflation, systemic risk, and monetary decay, and silver is listening. As capital rotates out of collapsing debt and into tangible stores of value, silver's dual identity as both a precious metal and an industrial workhorse makes it uniquely explosive. With gold already proving that trust in fiat is breaking down, silver is positioned to outperform. Not because it's more valuable than gold, but because it's more volatile and far more overlooked. This isn't just a gold bull market. This is the start of a precious metals reset. And when silver starts to run, it's going to do what it always does: overshoot every prediction and leave every latecomer behind.
Craziest things that I've read in a long time. I'll read it to you. You know, the EC is one thing for you and I to say all of these things, but it's another thing to hear it from the ECB. It talks about vulnerabilities have arisen because of commodity markets tend to be concentrated amongst a few large firms, often involving leverage and a high degree of opacity deriving from the use of OTC derivatives. Margin calls and the unwinding of leverage positions could lead to liquidity stress amongst market participants, potentially propagating the shock through the wider financial system. Additionally, disruptions in the physical gold market could increase the risk of a squeeze. In this case, market participants could be subject to significant margin calls and or have trouble sourcing and transporting appropriate physical gold for delivery in derivative contracts, leaving themselves exposed to potentially large losses. Well, that sounds like what we've been talking about for a long time. And that's, you know, look at the LBMA, 8 weeks delivery on a T+1 exchange, opaque. Yeah, no one knows what's going on there. And the leverage that these physical gold market participants are engaged in, that's exactly what they're saying. You have them coming out and saying it's a threat to the entire system. Well, you're darn right it is. And this is what is being exploited by much of the world right now because they understand just what we're doing.
Silver isn't just reacting to gold, it's launching on its own. What we're seeing now isn't typical trailing behavior. It's a breakout. For years, silver lagged behind, trapped in the shadows of gold's rally. But not anymore. In 2025, silver is breaking formation and moving with conviction. Why? Because it's no longer just a monetary metal. It's a pressure valve for an entire collapsing system. When fear spikes, when liquidity dries up, when inflation creeps back into the headlines, silver becomes the escape hatch. And with prices hovering just above $33, investors are realizing how undervalued it truly is. But it's not just retail pouring in. Institutions are waking up. ComX volumes are soaring. Physical premiums are rising. Delivery requests are smashing records. And unlike past cycles, this isn't driven by hype. It's driven by desperation. The banking sector's showing cracks. Bond yields are unstable. And the Fed's policy moves are undermining confidence faster than ever. Every ounce of silver that leaves the vault and enters long-term storage tightens the market further, reducing available supply and igniting the next price leg higher. This is what happens when silver shakes off its chains. It becomes a beast, unpredictable, unstoppable, and capable of parabolic moves that make headlines look tame. The industrial demand, the safe haven flows, the dollar collapse narrative, they're all converging. And for the first time in over a decade, silver isn't just playing catch-up, it's leading the charge. And that's a shift the market isn't ready for.
If there's not demand at these levels and the Fed has to come in to prop it up, to keep rates from blowing up, but if there isn't demand and you see auctions that haven't failed but have very lackluster demand, and who knows how much the Fed or shadow entities that represent the Fed in the Cayman Islands or whatever are bidding this stuff up, it will just become obvious at some point that that's the debt spiral, rising rates, and more money printing to buy the bonds to keep it down, and it just goes on and on and on and on. We're right there. So that's the point. That's why we're trapped. At some point, there's always a buyer for the debt at some rate, but there doesn't seem to be much appetite at these levels. So you're beginning to see rates start to move into levels that in months past have started to rattle the system, the banking system in particular. But if they do jump in, they've lost all credibility. And, Trump wants the rates lower. But remember, our dollar's lost 9% already. So how do you run a world reserve currency with all of this debt, with rates that are not commensurate with the falling of the dollar and the debt accumulation? no one wants to buy it, let alone the way that we behave with these countries, threatening them with sanctions and tariffs. They're finding alternatives. They truly are finding alternatives, and it's becoming very obvious to me. So yes, that is the playbook, come in and rescue the day. But if they do that, where's the credibility and where is the demand for treasuries when you look at a country that is resolved to never normalizing their balance sheet? And that's why people are saying that Japan's going to do the same thing right now. After all of these years of suppressing rates, the Japanese government owns 52% of the bond market. Well, where's their credibility as rates go higher in an attempt to normalize their balance sheet and sell those treasuries into the market? They too have the who to problem. Who do they sell them to? Who wants them? Everyone else is gone. And we're beginning to witness a similar pattern here where the big buyers of our treasuries are moving in the other direction. And you take away the carry trade, rocket fuel, where people can borrow money in low priced yen and then convert to dollars and buy Nvidia or Bitcoin or Apple or treasuries at that spread. Now that's disappearing very quickly. The unwinding of the carry trade can be just as viciously bearish as the ability to use the carry trade. So yeah, these are dangerous times for certain. And I think it all is going to be centered around the debt markets, which are far bigger than anything else, far bigger than the Federal Reserve has the ability to contain. And we can see that by them coming in and buying the 3, the 30, or the 3, the 10, and the 30, and the rates are still climbing even with that participation by the Fed.
The ComX is under siege, and the numbers don't lie. In May 2025 alone, over 15,000 silver contracts stood for delivery, totaling more than 75 million ounces. That's not just unusual, that's historic. For context, typical delivery months might see a fraction of that. What we're witnessing is an unprecedented run on physical metal. Investors are no longer content with paper silver. They want the real thing. Bars, coins, vaulted ounces, and they want them now. This isn't retail panic buying, this is big money moving quietly but aggressively. Institutions, funds, even sovereign entities are showing up and demanding physical delivery. JP Morgan and other bullion banks are being forced to transfer out inventories, shifting the balance of power in a market that has long relied on fractional backing and opaque supply. When too many people demand delivery in a system that only has a fraction of what's promised, the illusion breaks. And that illusion is breaking right now. Veterans of the 2011 silver squeeze are seeing deja vu, but on a much larger scale. Arbitrage opportunities are vanishing. Vault stocks are draining, and the premium for immediate delivery is rising sharply. This isn't a drill. It's a structural shift, a slow burn bank run on silver, and every contract delivered is one less ounce available for suppression. The shorts are bleeding, the cracks are widening, and the ComX, long, the gatekeeper of silver's price, is starting to lose control. This is where physical demand meets financial unraveling. And when the vaults run dry, price becomes irrelevant. What matters then is who holds the metal.
We're this close to watching the whole ComX blow up because of all of the delivery requests. Well, who's standing for delivery? Over 16,000 contracts so far in May. He's saying it's the government. And the government says, I don't care how stupid you are that you're short. Give me the gold. And he says it was just narrowly averted. At the same time, we see China, their gold imports into the country were 127.5 metric tons for the month, an 11-month high. The world is continuing to ask for delivery. This is where everything breaks. This is how everything breaks. And if you go back to 2020 and I started talking to you about the deliveries off of ComX, it started then and it's accelerating now. And since 2020, it's been a common theme. Prior to 2020, it was a never theme. No one stood for delivery. And when you see the LBMA go from T+1 to T+8 weeks, when you see a guy like Luke and Vince say this was a disaster averted on ComX and it's the U.S. government standing for delivery, things are starting to come into focus. And the rest of the world understands this. And that's why you see them at the same time standing for delivery. Things are getting really, 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 really interesting as far as I'm concerned in the gold market. The resilience. And I think silver's not far behind. You look at the technicals, they're identical with the exception of gold has broken up through the handle. Silver is right there at the technical resistance level. But look, What is different to me is that you have willing buyers throughout the world standing right underneath the 200-day moving average. And if they are foolish enough to use their bullets to suppress it, you have people standing there, countries, sovereign wealth funds, central banks saying, okay, we'll buy it and we'll stand for delivery. And you're seeing this. This is a wake-up call to the participants of the gold market and to those that are silly enough to be naked short.
Silver's rise isn't just about fear. It's about function. Beneath the headlines and panic-driven buying, there's a relentless industrial engine pushing silver's price higher. Solar, EVs, electronics, AI infrastructure. These aren't trends, they're revolutions. And at the core of each one sits silver. It's not optional, it's essential. In 2025, industrial demand is expected to hit nearly 680 million ounces, with solar alone responsible for over 190 million. That's more than just a statistic, it's a chokehold on supply. Here's the critical point. Silver isn't just valuable because it's scarce. It's valuable because it's irreplaceable. In solar panels, it's the single most effective conductor. In EVs, it ensures reliable electrical flow in safety-critical systems. In the world of AI, where power efficiency is king, silver keeps high-performance chips cool and connected. There's no substitute that delivers what silver does, at the scale and reliability these technologies demand. And this isn't hypothetical growth. Governments worldwide are legislating this transition. Billions are being poured into green infrastructure, and those mandates are locking in future silver demand for years to come. By the time the market catches up, the metal will already be spoken for, baked into solar cells, embedded in EVs, locked into microchips. That's why the price isn't just rising, it's recalibrating. Investors often underestimate industrial demand in favor of monetary narratives, but that's a mistake. Because while fear may drive short-term spikes, industrial demand builds long-term floors. And in 2025, those floors are rising fast. This is not a bubble. It's a structural squeeze with real-world foundations. And silver isn't going to wait for the market to wake up. It's moving now.
About that, get out of here. When you ask Rick about that, he'll say it's gold and gold-related equities. So it's not just gold. It's actually gold and gold stocks and ETFs. I mean, it's nothing. And that's why I've always said that this market ultimately, in my mind's eye, will be defined by an inability to readily source product because it is such a small amount. And if anything happens that would wake people up, the mainstream, in a few hours, everything would be gone. I mean, that's the truth. Eric Sprott and Rick Rule and a couple other people could empty their wallets and buy up the whole industry in an afternoon. As silly as that sounds, they could. I mean, if you had a few $1 billion thrown at the retail market in this country, and then you get to a point you have to wonder at some point if we see this thing unfold, where gold really starts to move higher and silver really starts to move higher. And at what point do the mints around the world start to rein in their desire to provide Krugerrands and Kangaroos and Philharmonics and Britannias to the United States? Wouldn't it be better to keep it onshore, to become more nationalistic rather than global? And I think that will happen. So yeah, I don't say that to better hurry up and get it now, but I think these are things that I think about all the time. And again, I'm the little boy who cries wolf, but I do believe what I say. I just, have a bad habit of being way early on these things, but I do think they will happen. It's all about math at this point, and the math of where we are just doesn't add up to the rest of the world being keen on holding our dollars or holding our treasuries or continue to fund our exorbitant lifestyle when we are, here we are, even with Doge, and we're asking to raise the debt ceiling and have another on the horizon $2 trillion deficit. Not a good mix.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell, comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. The supply side of silver is tightening like a noose, and the market is only just starting to realize it. On paper, mine production is forecasted to rise slightly to 35 million ounces in 25, but that number masks a deeper crisis. Recycling has flatlined, new discoveries are drying up, and many of the world's richest primary silver mines are in terminal decline. Places like Peru and Australia, once global leaders, are seeing falling output, while growth from regions like Mexico and Chile can't make up the difference. Even with the small uptick in production, total supply still falls far short of demand. The projected deficit for 2025 is 117.6 million ounces, a shortfall that's not just large, but chronic. And deficits like this don't go away quietly. They compound. Every year the market runs short. Inventory vanishes, vaults are drawn down, marginal buyers are priced out. And at some point the system hits a wall where paper silver contracts no longer matter, only physical metal counts. This looming supply crisis isn't speculative, it's structural. Years of underinvestment, rising production costs, ESG regulations, and community resistance to new mining projects have all but guaranteed that silver supply will remain constrained. And with mine output expected to peak in 2026, the window for relief is slamming shut. What happens when you combine relentless industrial demand, rising investment interest, and a multi-year supply crunch? You get a market primed for an explosive revaluation. And with every ounce pulled from the ground already committed to solar, EVs, or industrial use, there's simply not enough left for investors chasing safety. That's the trap. And once it springs, silver won't just rise. It'll gap up, leaving the slow movers in the dust.
There are a lot of people who will question the motivation of President Trump that he was here or is here to usher in the surveillance state. It starts with the digital ID that he is saying you can't vote without it. He's using it under the guise of election integrity. Is it the opening the door or Pandora's box into the digital surveillance state? I'm not saying I believe it or not. I'm just saying, and then you see things like this, you know, what does that have to do with anything? And why would that be stuck into the bill? That's what they do, I guess, in Washington. But you have to wonder the motivation behind it. And instead of these bills being straightforward, they are thousands and thousands and thousands of pages, and these things are buried in it. I happen to think that AI is revolutionary. It makes a lot of things much easier, but it's going to change the world in a way that I don't think people maybe are even prepared for. You know, I tell the story of my son who now works for Miles Franklin, but he graduated with a degree from the Ross School of Business and then went promptly to Manhattan to become an accountant at Price Waterhouse, getting paid what I thought was barely subsistence living of just over $70,000. It's a great living in Minneapolis. It's not so much in Manhattan. Was living with two other guys in a tiny little box-size apartment. But the point I'm getting at is, why do they need to pay a kid 70 grand to analyze the balance sheet of a real estate investment trust when AI can do it in 2 seconds? And I don't think we begin to see anything yet. The whole accounting profession is going to change, as is so many professions, radiology, the doctors that, and now you see Medtronic come out with a robotic surgical machine that, is advancing so fast it will take over for surgeons. And this whole AI revolution is kind of concerning. It's kind of scary. I personally liked it in the 70s and the 80s before cell phones. I think it's growing to a level where there should be a lot more pushback and a lot more thought on it as to what the ramifications are. But I guess once the Pandora's box is open, it's too late. I didn't know that, and I think it's kind of frightening that they would try to slide that in. The states should have the ability to push back on many things, whether it's marijuana or cryptocurrencies or whatever, or CBDCs or gold. Oh, would you knock it off, buddy? Sorry. That gold is, I'm building a new studio. I'll be in there in maybe 10 days. This will never happen again. But using gold as legal tender, I was just talking to Jason Cousins from Glint, and he says to me, Andy, my insiders tell me that Governor DeSantis is going to sign the bill probably on Tuesday. So these are things where, the federal government says, well, you have to use this, but the states have the ability to say, no, we're going to use this, or any of the things that the states choose. from abortion on down. These are things that are the prerogative of the state. And to put something in there and say this cannot be done should alarm everybody. And I think AI is something that should alarm everyone, especially if you have kids, as to where their path is and what they're going to do in the future to make a living.
While the West sleeps, China and Russia are quietly stacking silver, and that should terrify anyone who understands what it means. In 2025, Russia made its intentions crystal clear. $535 million earmarked for silver purchases over just 3 years. That's over 16 million ounces at today's prices, directly accumulated by a state actor with no interest in paper claims. This isn't about speculation, it's about preparation. And they're not alone. China's been hoarding silver even more aggressively, redirecting industrial supply, cornering future contracts, and building reserves away from the public eye. Why? Because they see the writing on the wall. The petrodollar is fading. The U.S. bond market is cracking. And fiat currencies, especially the dollar, are losing their grip on global trust. In a world moving toward de-dollarization, hard assets become strategic weapons. And silver, with its dual monetary industrial identity, is fast becoming a geopolitical chess piece. This isn't conspiracy, it's a realignment. While Western institutions debate rate hikes and CPI tweaks, Eastern powers are accumulating the very metals that survive financial resets. And they're doing it while prices are still laughably low. Silver at $33 is a gift, and they know it. The goal isn't their return on investment, it's a return of power. And every ounce they buy is one less available when panic sets in. The mistake the West is making, again, is assuming the game hasn't changed. But it has. We're not just talking about investment strategies anymore. We're talking about economic warfare. And in that war, silver is becoming ammunition. The quietest moves being made right now are also the loudest warnings. Ignore them, and you'll miss the most important shift of our financial era.
So, no one's going to buy them to melt them down. So, yeah, I mean, that's the currency. If that's the case, the currency falls as the currency falls. And it is falling. I mean, and it's falling. It's fallen 9% this year. So that's what President Trump wants, of course. And that's, you look at the Mar-a-Lago Accord, it speaks of a weak dollar. That's what they want. That's what he's getting. But now you're going to run into problems with who wants to take our treasuries in that environment, who wants to take our dollars in that environment for the goods that we sell, or that we buy, rather. So this is the quandary. This is what happens when you mess with Mother Nature the way that we did, and you suppress interest rates for 2+ decades, creating distortions and misallocations in resources and capital, and distortions in asset prices. When things try and find equilibrium with reality, especially in a rising interest rate environment, the biggest shock to all will be the asset prices that regress to the mean. So, this is part of the reason he wants low interest rates and low, a cheap currency to help our exports and whatnot. But, remember, it is because of the reserve status that we have low interest rates and that we have cheap goods and that we have high asset prices, because the world has been buying our currency, which makes our currency strong. This is Triffin's dilemma. And you will always have strong currency as the world reserve currency, because there's greater demand for it than we can supply through commerce, just simply people buying our stuff, or vice versa. And so then you end up with a situation where it's so much cheaper to send your manufacturing across the world to the countries that are inexpensively producing it in their cheap their inexpensive currency, that you eviscerate your manufacturing. This is why we have trade imbalances, and it is for that. And is it unfair? I don't know. Is it unfair that there are tariffs by these other countries when we get the benefit of being the world reserve currency, which has enabled us to live high on the hog and have low interest rates and high asset prices and cheap goods? Well, you reverse that. And I agree, we need to bring this stuff home. There's no easy way to do it. We have to. But it'll be a process whereby if it reverses, now you have high interest rates and goods that are more expensive, shelves that are half full, Wall Street that is seeing falling prices, companies that are making layoffs. You don't have the benefit then that we've enjoyed for a very long time. So it's a double-edged sword. And I don't know what the right answer is, but I will tell you that you can tell that he's certainly agitating a good portion of the world with these ideas, and at the same time, you know, we're witnessing in real time how the bond market is just losing demand from the people that have supported our indebtedness and our spending for the last 50 years.
The banking system is starting to buckle under its own weight, and silver is emerging as a direct beneficiary of that unraveling. Delinquencies are rising, 1.69% on credit cards, and climbing fast. Commercial real estate is a ticking time bomb, regional banks are teetering, and major institutions are quietly slashing headcounts, raising liquidity buffers, and tightening lending standards. But none of this is showing up in the headlines, yet. Because the system doesn't collapse all at once. It erodes, day by day, deal by deal, until suddenly something breaks. We've seen this movie before. Rising rates, stressed balance sheets, and blind optimism until the dam bursts. But this time, there's no room for another bailout. The Fed's toolkit is exhausted. Every rate cut risks fueling inflation. Every delay tightens the vice. And investors know it. That's why capital is flowing into hard assets. That's why silver is waking up. Because when trust in banks evaporates, the only thing left is what you can hold in your hand. Just look at the ComX delivery data. Look at the surge in physical demand. Look at the premiums. This isn't speculation, it's preparation. It's what happens when people stop believing in the system and start hedging against it. And silver, still underpriced, still accessible, is absorbing that fear with ferocity. The pressure is mounting. Behind every bank balance sheet is a pile of paper promises. And the moment one of those promises breaks, the rush into silver won't just accelerate, it will go vertical. This isn't a hedge anymore, it's an escape hatch, and it's getting smaller by the day.
Saudi Arabia has been kowtowing to the president with massive oil pumping to keep the price of oil down. Maybe it's a deal they're making. They're straddling the line. Remember, they were a full participant in Enbridge before it got yanked out. They're talking about allowing the Shanghai Metals Exchange to build a vault of the Shanghai Metals Exchange in Saudi Arabia. They're doing one in Hong Kong too. Why would they do that? Well, they'll trade, they'll buy oil from Saudi Arabia, China will, and they'll trade over the bridge technology, and they'll use digital yuan and settle imbalances in gold, and the gold is right there in Saudi Arabia. So they're playing both sides, as they probably should. But these countries, I think, have already lost faith in this country. And President Trump won't be president forever, and they're building a plan B. They're building the back channels. This is the difference. And when you think of what Eric Young said, King Kong on X, don't sell your silver. China's part of this. They're part of the suppression. They are buying every ounce they possibly can to supply their future generations with enough silver. They are trying to corner the physical market. That's why, as the second largest producer in the world, they're buying doré and concentrate. Why the hell would they do that? Pay twice what the West will, send it back to refine it. Why? Because they're trying to use the last maybe days of the Western pricing system to their advantage. And, when you see these massive, when you see Vince Lancy said we were this close to the whole market blowing up, well, that's this month. What happens next month? To my knowledge, I don't even think May is an active delivery month for gold. It is for silver. And it was also the largest delivery of silver in the history of the ComX market so far in the month of May. So, price is a tool of misdirection. Volatility is a tool of misdirection. But look underneath the sheets, and what you see is these players continuing, regardless of rising rates, regardless of volatility, regardless of anything. Mm-hmm. They're standing for delivery. And that's where things begin to get very, very interesting. And it centers also not just on gold and silver. It's choosing gold and silver over dollars and treasuries. And that's really the statement that I see happening. And, people, I think, get disenchanted with how long it takes. And the instant gratification that's ingrained in this society is something that doesn't allow people to have enough patience to see the long game is being played right out from underneath us. And they're doing it knowing that that's how we look at things. Not only that, we have a media that doesn't alert us to any of this stuff. Right. So, people are blindsided, as Kiyosaki always says to me, people can't get out of the way of what they don't see coming. It's true. And no one sees this coming except maybe the biggest traders on the planet here on the ComX who are standing for delivery. Why are they doing that? in enormous amounts. Just the amount of gold in the May and the March contract combined, you're talking $10 billion. Well, who's got $10 billion to buy gold? Just in those two contracts alone. I'm not even talking about January, February, April, and you put it all together and you're talking, I don't know, well north of 20 billion just in gold. And I don't know how much silver, but a lot. This is the largest delivery in the history of the ComX this month. And it's the 21st. It's not over yet.
All the signs are converging. Debt markets unraveling, the Fed injecting hidden liquidity, trust in fiat eroding, and physical metal vanishing at record speed. And through it all, one asset is perfectly positioned at the center of this storm: silver. What we're seeing isn't a random rally, it's a systemic repricing. Every component of the financial machine is flashing red, yields spiking, inflation rising, dollar strength faltering. Institutional investors are no longer speculating, they're fleeing to safety. And they're not just buying gold anymore, they're buying silver in size. Because here's the difference. Gold is expensive, silver is still affordable, gold is well known, silver is underestimated. But structurally, silver is tighter, rarer, and more explosive when it moves. That's why the smartest money is betting on it now. Not for a double, but for an event. A blow-off top. A short squeeze. A monetary reset. When that moment comes, silver won't climb gradually. It will gap higher, melt faces, and shatter expectations. The groundwork has been laid. ComX inventories are drying up. Sovereign hoarding is accelerating. Mine supply is capped. Demand is locked in. The fuse is lit. And the only question left is how high the price can go before the market breaks entirely. $50 is history. $100 is a target. $500? That's not just possible. It's the logical outcome of a broken system desperately trying to patch itself with printed dollars and public spin. Silver isn't waiting for permission. It's already on the move. And when the dam finally breaks, there will be no warning, no time to react, only those who are ready and those who are left behind.
And who knows what it is to that pushes it over the edge. I think one of the things that would exacerbate the loss of confidence in the dollar would be like what we talked about last week, where this new bridge technology that is being rolled out by China, which is the M bridge, which they've hooked up with the Asian nations and the Middle East nations, which represent 38% of global GDP. Remember what the Russian finance minister said: we're opening this up to other nations as well that are not BRICS nations. Well, you have 42 countries, Vietnam being the 42nd to apply, or 44, one or the other, but that have applied to the BRICS. But you have the Shanghai Cooperation Organization, the Eurasian Economic Union, and the Belt Road. Put all those countries together that are aligned with the BRICS, that intend to use local currencies over the central bank bridge, this bridge technology, and settle imbalances in gold. And very, very quickly, you have an alternative to settling transactions globally and perhaps even replacing the treasury with things like gold. I'm not saying it's going to happen, but what I'm saying is the argument is that they always say the dollar's the cleanest shirt in the dirty laundry hamper, but there's never been a challenger. Well, I'm not saying that this will be a unified currency, but if enough of the world settle in their own currencies and then save in something other than treasuries, Houston, we have a big problem. And it's the same thing as a unified currency. In fact, maybe it's even stronger because now everyone is using their own. So what are you going to go to war with everybody? And when you talk about all of these countries in this massive swath of human population, it is a genius stroke for Lavrov to say, we're opening it up to other countries. Now, I'm just guessing that they would use the Belt Road, the SCO, and the Eurasian Economic Union. They've already brought in the Asian countries. If they do that, and they say all of the Belt Road participants, every one of them can settle in their own currency, and any imbalance will be settled in gold, SWIFT won't even know how much commerce is happening, because the way that it's measured by the U.S. is how much business is transacting. It's going through the SWIFT channels. This stuff settles in 7 seconds instead of the 3 to 5 days going through SWIFT intermediary banks outside of SWIFT purview. It's not compatible with the dollar. So I think when you see something like that happen, and who knows if and when it does, I mean, you hear it's the primary objective of the July meeting in BRICS is to find a common settlement program. And when Lavrov comes out and says we're opening up to non-BRICS nations, I mean, that could accelerate this whole de-dollarization thing really promptly. So I don't know if there's a number, but I think you're witnessing it where the Fed has to come in right now to buy the treasuries, and the dollar continues to fall. You're witnessing it in real time.
The pieces are all in place. The debt market is collapsing, the Fed is cornered, and the world is losing faith in fiat money faster than ever before. Gold has already launched, but silver, the more volatile, more accessible, and more suppressed metal, is now in breakout mode. This isn't hype, it's math. With a 117 million ounce deficit, record ComX deliveries, relentless industrial demand, and central banks quietly hoarding physical silver, the system can't sustain itself much longer. We're standing at the edge of a historic revaluation. Silver at $500 isn't some fantasy number. It's where the forces of supply, demand, and monetary failure collide. And when the paper game ends, the only thing that matters is who holds real metal. So if you've been watching this unfold, waiting for confirmation, here it is. The storm isn't coming, it's here. The silver reset has already begun. Subscribe now to stay ahead of the collapse and make sure you're not the last one to figure it out. And remember, this is not financial advice. Always speak to a professional before making any financial decisions.